If you're trying to get out of the rat race, one of the easiest things I teach my students to do is to eliminate liabilities. Your house is a liability. It's taking money out of your pocket. And if you want the secret formula to pay your house off in record time, this video is for you. Hey there, YouTube. Corby and Tifro, getfinanciallyfree.com with another video to help you get out of the rat race. In this video, I'm sharing with you a little clip from one of our recent classes where we help our students acquire assets and eliminate liabilities. Your mortgage payment is a liability because it's taking money out of your pocket. The quicker you eliminate your mortgage, the quicker you can live a life of financial freedom. If you're sick of making the banks all that money and you'd like to keep that money for yourself, sit back, relax. All that I ask is that you give this video a thumbs up and you subscribe so that we can continue producing more of this free content for you.
Are buying houses right now, which is great. Congratulations on all the people who have been able to buy one or two houses. And we've talked largely about how you can pay down these houses after you've purchased them or after the refinances. But I kind of want to focus a little bit on how the decisions you make before you even purchase the property can have a huge difference on how long it takes you to pay off the property in the end. And so it's important. No one's going to tell you how to do the math. It's really important for all of us to be able to do the math ourselves because bankers, nobody's going to do the math for you like you're going to do the math for yourself. So I'm going to share my screen here. Where are we at? I'm going to send you a request, Corby. It's not turned on.
Yep, you got it.
Awesome.
Thanks.
All right. All right. So we're going to take a look at an example of a house, each of which we'd be buying for $150,000. Okay. In house one, we have the ability, we have up to $15,000 to put down because that's going to be the question that most people are going to ask when you purchase your or do a refinance. A lot of people are like, well, should I put more money up front to lower my interest rate and or increase the cash flow? A lot of people are going to try to figure out if I put more money down, can I, have a lower payment so that my cash flow over the life of the loan is going to be better? Or can I buy down points? Or do I pay high origination fees? And the people who are selling you the loan officers and whatnot, are not going to kind of tell you the best options for you. So I want to kind of run through the math on that. Again, we have a $115,000 house, 6% interest on both, and you have up to $15,000 to be able to put down on the house. So in house number one, you're like, you know what? I want to get the most amount of cash flow I possibly can. So I'm going to put down the full $15,000 here. I'm going to finance $135,000. My monthly payment will be $809.39. And over the life of the loan in that scenario, I would pay $156,000 in total interest. Well, in scenario two, you've basically used your entirety of their $15,000. Now, in scenario two, we have the same $150,000 house, but instead of $15,000, we have the ability to put just $5,000 down. What's the difference, right? Well, still 6% interest. I'm financing $10,000 more, so $145,000. My payment literally only goes up by 60 bucks. And I only save $11,000 over the life of the loan. So really and truly, having spent an extra $10,000 in my down payment really hasn't netted me anything more than an extra $60 a month and $11,000 over the life of the loan. I think Corby would say put the least amount of money down, right? And then
Correct.
use the other 10,000 to buy two additional houses, right?
Yes.
I mean, that makes all the sense in the world because now you can, if you can rent your houses for, let's say, 12, 13, $1,400, you have the ability to turn this $15,000 down payment into $1,000 to $1,200 of cash flow rather than just gaining an extra $60 a month. So that's part of the calculus that you're going to want to be looking at when you're buying or refinancing houses. Also, there's a third option that no one is going to talk to you about, least of all the officers. And it kind of goes in tandem with what we've been learning the first couple of weeks, which is scenario two with a twist. And that is I still put $5,000 down, but now, let me move this over. Instead of, let's say I'm just hell-bent on spending the full $15,000 on this house, I am going to, this is scenario three. I'm going to move these over here so that they're not as distracting. We know scenario one's not a good option. So now I've got a $150,000 house. I've put down my $5,000 and I financed 145. But now I have the ability to make a $10,000 extra payment. And if I were to do the exact same thing, I utilize that $15,000 instead of doing as a down payment, I just make an extra $10,000 payment. Well, now I've instead of saving $11,500 over the life of the loan, I actually have saved $42,000 just by moving the money over, making the payment, on my first payment rather than putting it down as a down payment. And I'll show the calculation here uh, as well, so you can actually see what that looks like. I've got my $145,000 at 6%, 30 years. I would be paying $167,965 in total interest over the life of the loan. If I put $10,000 extra on and I only finance my 135,000, it only goes down by about 10, 11,000 as we saw. But if I put a $10,000 just extra, I'm just moving when I make that payment. Yes, I have to pay extra $60 a month, but kind of worth it. I will have now saved $42,000 in interest. Now, no loan officer ever anywhere is going to tell you about that. But the decisions that we make, even before we purchase the houses that we're looking at, are going to severely affect the options that we have moving forward. By the way, that $10,000 extra payment is not only a $42,000 interest savings, but it also saves you 60 payments. So you're actually saving an extra, what, 5 years on your loan. You've turned that mortgage into a 25-year mortgage instead of a 30-year mortgage. I still would agree with Corby that it makes more sense if you're in the accumulation phase of buying assets to split that $10,000 up into two additional properties. But as you're looking at refinancing, because a lot of you guys are in hard money loans or looking at purchasing properties, or not just for investments, but for your own personal homes, you're going to be looking at, well, how much money should I put down? What is the maximum amount of my monthly payment? If I make an extra payment on the down payment, how much more will my payment go up? If I take that money and make an extra payment down the line, how much can I save? These are questions that you're going to really want to understand how to do the math on yourself to be able to make the best decisions. And Corby, I think, knows, especially when you're looking at your refinances, a lot of people are going to like, well, do you want to buy down the interest rate? You could spend an extra $3,000 to buy down an interest rate, but the payment amount is really not going to be that much different. 5.5, let's say.
Right.
Well, I could save an extra $40 a month. That $40 may not make a lot of difference to you on a monthly basis, but that $3,000 on an extra payment or in the ability to buy another asset producing income producing asset may give you a lot more flexibility. So that's one of the reasons that you guys are taking these classes because we want to make sure that you guys are set up to understand how to use your money, how to keep it as long as possible, how to use it to make sure that we're paying down and we're not giving just giving the money extra to the banks. And that's a critical piece. So, is there any questions on this portion of what we've been talking about? Corey, do you have anything to add on
Um, yeah, let me go ahead and let me jump in here and talk about that $10,000 chunk payment. This is one of the things that, first of all, I want to make sure and I